All right, today
This is
we're
a
going to do the
demonstration
Biomet
of
LBO
Flip for
presentation
Mac.
with Stephen, Chris, Robbie, and Jordan. In 2006, Biomet, an Indiana-based medical device maker which makes artificial hips and knees, saw disappointing earnings in recent quarters, pushing the stock price down. Orthopedics, a $20 billion industry, was facing issues including uncertainty about the outcome of a federal investigation on whether the major companies were making illegal payments to doctors to
This is
gain
a
sales.
demonstration
The main
of Flip
concern
for
was
Mac.
slowing growth in several product segments, including reconstructive hip and knee operations that had long been the massive profit generators for companies. The number of orthopedic operations was growing steadily and expected continued growth for many years as baby boomers would outlive the bones and tissues in their joints. There were few major innovations to justify price increases. As devices were becoming commoditized, prices were actually falling at a rate that more than offset the increase in unit sales.
This is a
Biomet
demonstration
chief
of
executive
Flip for
Dane Miller,
Mac.
one of the largest shareholders, owning 2.3%, abruptly and unexpectedly resigned. Biomet then hired Morgan Stanley to explore strategic options for the company, including a sale. Biomet was debt-free. It was big enough to survive as a standalone company, so this wouldn't be a distressed sale. Competitors considered to be potential buyers were Medtronic, a broad-based medical device maker and leader in spinal implants, Abbott Laboratories, a drug maker that had been
This is
diversifying
a
into orthopedic
demonstration of
devices,
Flip for Mac.
Zimmer, DuPuy, and Stryker were the industry leaders but were less likely to be buyers because of antitrust issues. Smith & Nephew, a major British orthopedics company, had complementary strengths that many saw as a merger of equals. Together, they would have a combined 20% share of the knee and hip market, or as much as the industry leader Stryker. The LBO fund participants included Blackstone Group, Kohlberg Kravis and Roberts, Texas Pacific Group, and Goldman Sachs
This
Capital
is a
Partners,
demonstration
with
of Flip for
advisors to the
Mac.
Biomet board of directors from Bank of America, Merrill Lynch, and Goldman Sachs. December 2006, Biomet said it would sell to a consortium of private equity groups for $44 a share, or about $10.9 billion. A European rival, Smith & Nephew, had preliminary talks and was expected to bid more than $11 billion. But even though it was a higher offer, there were too many conditions that could scuttle the deal. By June 2007, the
This is a
fundamentals of the hip and
demonstration
knee
of Flip
construction
for
market
Mac.
had improved, and so had Biomet operations, resulting in the share price rising above the offered $44. June 2007, after a shareholder advisory firm urged shareholders to reject the previous $10.9 billion offer, Biomet accepted a sweetened takeover bid of $11.4 billion before the June 8 special meeting could take place to vote on the original offer. Many companies are based out of Delaware.
This is a demonstration of Flip for Mac.
Laws surrounding corporations. In Delaware, dissident shareholders are able to obtain a third-party appraisal of the target company. Indiana, however, provides little legal recourse for dissident shareholders. According to the Schedule 14A filed with the Securities Exchange Commission, Biomet shareholders have no dissenters' rights under Indiana law in connection with the merger. As such, the Biomet shareholders were unable to obtain third-party appraisals of the target.
This is a demonstration
Such
of
third-party
Flip for
appraisals
Mac.
have the potential to increase the purchase price. Indiana law also differs from Delaware law in that Indiana requires 75% of shareholders vote in favor of the deal. The general rule for Delaware incorporated companies is that a majority of all common shares vote in favor of the deal unless a higher percentage is specified. In December of 2006, Biomet uncovered
This is
several
a
instances of stock
demonstration
option
of
grants
Flip for
being
Mac.
backdated to create immediate profits for their recipients as far back as 1996. In order to deal with these accounting errors, Biomet delayed their next earnings release. Reports say that senior executives were aware of the backdating but may not have known the legal ramifications of this practice. Biomet's British competitor, Smith & Nephew, was in negotiation for an expected $11.4 billion purchase price of Biomet.
This is a demonstration of Flip for Mac.
Of potential accounting errors. Smith & Nephew investors were relieved as many suspected the company would have paid too much for Biomet.
Moving now to the transaction summary, we show here the sources and uses of this deal. On the right, we see the uses being that the purchase price of equity was $11.2 billion, given the $46 per share price point, as well as $246 million.
This is a
246 million shares
demonstration
outstanding.
of flip for Mac.
Also, we see on the left the sources, where the four providers of capital each gave $1.3 billion, as well as a tender facility from the borrower of $6.16 billion. Here we have historical figures for the net sales, as well through the diluted shares on an EPS basis. We see both growth in EPS as well as growth in the top line, which proved to be advantageous for the debt.
This is a demonstration of flip for Mac.
Here are some projections given to us by Morgan Stanley, the advisor to Biomet's board. We show here that net sales are increasing as well as net income, and as well as capital expenditures, even though the firm continues to be operationally sound. Here are some calendarized financial statistics, again based on filings by the company. We have a enterprise.
This is a demonstration of flip for Mac.
12 to 13 times for Biomet, as well as a implied range of $39 to $44. All the way through our PE ratio in 2008 of expected 19 to 22 times. This is a precedent transaction summary across two valuation metrics of enterprise value to sales and enterprise value to EBITDA, where we see means of 5 and 24 times.
This is a demonstration of flip for Mac.
For precedent transactions throughout the industry. Here is a valuation metric summary for comparable companies. These are the 5 main competitors that participated, that were part of our analysis. We see here that Smith & Nephew actually had offered a purchase price of Biomet at one point, but Biomet's offer price here is 14
This is a demonstration of flip for Mac.
And 12.3 times their 2008 EBITDA, which both sat higher than the means of their competitors. This is a valuation summary as well, with the DCF, LBO, transaction premium, and research estimates. The LBO analysis was of strongest consideration for us, given that the merger agreement gave a $46 share price. That said, they showed a 17 to 22.5%.
This is a demonstration of flip for Mac.
13.5 times the LTM EBITDA. Research estimates also indicated with a discount rate of 8%, a valuation range of $32 to $44.
The main sticking point for Biomet not accepting the first offer from the private equity consortium was the recommendation of proxy advisory firm Institutional Shareholders Services, ISS.
This is a demonstration
ISS
of flip
that with
for
the
Mac.
improvements of Biomet's operations and advancements in the industry, that Biomet's share price had not increased as much as its peers or as much as it should have. This resulted in a tender offer of $46 per share for an increased value of $11.4 billion. In addition to a higher price, a tender offer had many advantages over the merger agreement that was originally proposed.
This
First,
is a
it allowed
demonstration
the
of flip for
consortium
Mac.
to conduct a faster sale, as Biomet would not need to file new proxy materials. Second, a tender offer eliminates the need for a shareholder vote. Third, a tender offer removes the need of a proxy advisory firm like ISS, whose recommendations have a huge influence over institutional investors. As discussed earlier, Indiana state law required a 75% acceptance vote from shareholders. Under the new tender offer,
This is a
75%
demonstration
of
of flip for
must
Mac.
also be tendered or sold to the consortium to complete the transaction. This stays in line with the Indiana state law, but has an advantage over a shareholder vote, as shareholders are more likely to tender than vote, as the receipt of consideration will be delayed if shareholders fail to tender. This contrasts with a traditional merger vote, where many apathetic shareholders fall under the assumption that the deal will go through regardless
This
of
is a
whether or not they
demonstration
vote.
of flip for Mac.
Therefore, a tender offer has many advantages over a one-step merger vote and ultimately led to a completed transaction.
And that is the summary of the LBO for Biomet.